Hi all. Hi James. Nice to have you in our podcast. How are you?
Hey, Alessandro, great to be here. I'm pretty well. How are you?
Good as well. Thanks. I just finished recently another space for in the Italian Bitcoin Italian community. So today is the second, but as Bitcoiners, we will talk Bitcoin 24/7. So let's go on. And I want to say also hello to Francesco. Hi Francesco.
Hello, Alessandro. Hello, James. It's a pleasure to be here with you.
Awesome.
Yeah, definitely. Thanks, James, again for accepting the invitation. You are one of the biggest experts of microeconomics in the Bitcoin world. For your experience of hedge funds, I am reading weekly the Informationist. I always recommend everyone to sign on the Informationist because James is able to explain in a simple way difficult part of macroeconomics, and for us, the macroeconomic part is very important in order to understand how Bitcoin is going, the implication on Bitcoin. We had also Lawrence Lepard, Sam Callahan, and Jesse Myers Croeso. So we are very happy to have you here as well. So it will give us many great insight on macroeconomics. Maybe we can start analyzing which is your take of the current macroeconomic situation and where do you think we are going?
Yeah, from like a 100,000 foot view, I think there's a lot of confusion out there. We're, every single day you've got the market kind of moving around on Fed comments, on speculation of Fed cutting, on inflation prints, on unemployment numbers, and so people they're a little bit confused right now. And that said, the market just continues to kind of rip higher. We've just looking at the overall market and where assets are and what risk assets are doing. The S&P is right up on all-time highs, and so there's still capital out there. There's capital appreciation. There's capital being flooded into the market, seeing M2 expand. So there's confusion though, because you're also hearing people who are super frustrated about inflation, pricing, housing pricing, price of insurance, price of insurance on their houses, on their cars, and so you're seeing at least here in America, you're seeing the middle class get squeezed pretty hard. And so there's conflict in the numbers and what you're hearing from people and their dissatisfaction of their living, their environment. And so why is that happening? Again, from like kind of 100,000 foot view, you're seeing the Fed. We watched the Fed raise rates at a rocket pace over that 18 months in 2021 to 2022, or 2022 to 2023, and so people are a little bit confused. Why has inflation kind of bottomed out at 3%, which we've seen over the last number of months? And the real reason for that is that we're running nearly $2 trillion deficits at a time when we're not in a recession and we're not officially at war here, at least in our homeland. And so this is just it's kind of I would call it reckless. I would say that the government and Congress is just completely out of control of their spending, and those deficits are actually they're inflationary. So when you see numbers, you see job numbers, and you hear of young people who are really struggling to find jobs, yet you're seeing job numbers go up. What's happening is the government is hiring a lot of people, both federally and locally, and so that's kind of muddying the water for people in my mind. And so what we're experiencing is we're seeing pockets of recession in the economy, which are interest rate sensitive. things like commercial real estate, companies that have debt that's interest rate sensitive, that their margins are being squeezed by that. They're having to either lay off people or cut research and development and cut lines of businesses. And so you're absolutely seeing areas that are into recession here. But on the flip side of that, you're seeing areas that are expanding, and that comes from this quite a bit of this deficit spending that we're seeing out of Washington. And so you're seeing infrastructure projects, green projects, and all of that Social Security money pouring in from boomers retiring, and they're spending it. You can't go to a restaurant without seeing uh, a flood of people in there, and they're either older people, my age or older, and I'm Gen X, but or you've got young people who are buying on credit, and they're just trying to keep up, and they're just like, well, they've given up on the American dream of buying a home for now, so they're just going to spend their money on experience and restaurants and travel and doing what they want to do, because there's just no way they're going to get a home. So from that view, there's a lot of confusion out there, and there's frustration, but there's also there's capital that's still flowing into the market, and with M2 now expanding again, you're seeing markets kind of tilt towards all-time highs. So I'll kind of pause there, but that's my general overview.
Thanks for the insight and the overview. It's also true. We 1.5 years ago, when we saw this interest rate increasing from 0 to 5%, I think no one would have thought that after 1.5 year, the S&P 500 would have reached the new high, keeping for this interest for 5%. But as you said, they are keeping spending, so that's why we see the market liquidity. And on then the next question will be, where are we going? You focused a lot in your post, in your X tweets about the interest rate. I think it was 600 million 2 years ago. Now it's around 1 trillion, and in 1 or 2 years it will be 1.6 trillion, if I remember correctly. So it looks like there is only one way. It's clear where we are going, with the interest rate keeping increasing. What do you think?
You mean the interest expense on our debt?
Yes, interest expense. Yes, sorry.
Yeah, and that's part of the problem, right? So we're now spending, and I just posted some tweet about this earlier about our second largest line item on our budget is interest expense on our debt, and that's no joke. I mean, that's reality. That's where we are right now. We're spending more on interest on our debt than we do on veterans and education, transportation, all combined, and that's a shame. But that's where we're at right now, and that is not going to stop because when you look at an economy, and you look at a sovereign, and they're in this situation. And I've talked about this before. For those of you who have heard it, this is kind of a recap, and those of you who have not heard it, there's basically three options for the government. They can either have austerity, like we saw back in 2013, 2014 with Greece. They were forced into austerity, or which means cutting spending. But that was they're part of the EU, and they were kind of strong-armed into that. But we're the United States, and we have never cut back on spending. You can see it from party to party. It doesn't matter if they're Democrats or Republicans. Every single party spends more and more and more and more. We don't even have a debt ceiling right now. We're not going to address it until after the election. It's going to be January 2025 before we even touch on that again. So there's no incentive to stop spending, really, because we can just keep borrowing, and we can keep printing. But so that is the crux of it. Your choices are austerity, which is political suicide. Neither party will do it. Neither party is willing to do it. They try to trick each other into doing it, but it doesn't work. And so that's not going to happen. It's political suicide. The second thing you could do is raise taxes. We do have a problem with our tax structure here, and it's too complicated to even go into. There's so many complications with our tax structure, but when you raise taxes on the so-called wealthy in this nation, you're often raising taxes on entrepreneurs and small businesses, and that's not really what you want to do when you're trying to grow your economy. You're trying to grow your gross domestic product. But what winds up happening if you do raise taxes, especially if you raise them across the board, you wind up strangling production. So the businesses that are doing well, they have to cut back on R&D, they have to cut back on profitable business lines, they have to cut back on hiring, they have to cut wages because their margins get so squeezed that it's either that or they start shutting down. And so you wind up having the higher taxes on lower productivity, and you get to the same spot. And in reality, that productivity is now declining, so it's even worse. So then the third thing you can do is you can just issue more debt to cover that deficit, and that's what we've been doing, and we'll continue to do that. But in order to keep that charade going, in order to keep the ability to keep borrowing and keep issuing debt, you have to have inflation. There's just no way around it. You have to have negative real rates. And what do I mean by that? That means you have to have rates that are lower than inflation. So when the government goes to pay back those 5-year, 10-year, 20-year, and 30-year bonds, the dollars they're paying with are worth less than when they borrowed them. And so that allows them to continue this reckless borrowing. And that's what we've been doing. So because no country that issues debt in its own currency would default. That doesn't make any sense. But what they will do is they'll soft default every single day through inflation. And that's what we're seeing. And that's why, Alessandro and Francesco, that's why I focus on this, to make sure that people understand that it's extremely important to own hard assets such as Bitcoin, gold, silver. I own all these things. My focus is on Bitcoin. I have a hedge fund that invests in the Bitcoin space. That's what I do. That's a personal decision, but I believe it to be the hardest money out there, and it's the easiest for anybody who has any amount of assets to buy some. You don't have to, you're not buying a fractional share of a stock that has that has beta risk to the overall market, and you're not trying to buy a fractional share of some real estate project or something with high fees on it or something. This is something that anybody could buy any amount of. And that's why I try to educate people on this particular subject. It's very, very important for people to understand that the US dollar and every other fiat currency out there is being debased daily. And if you save your money in that currency, you're going to wind up losing purchasing power over the long period of time. Even if we do have interest rates that are 3, 4, 5% that you're making on money market accounts, you don't get that in your deposits and on your checking accounts. But if you are keeping your money there, you're staving off some of it, but you're not operating with a real positive real rate still long term. And because it's necessary for the government to maintain negative real rates, that's just reality.
The yield curve has been inverted for a very long time, kind of 570 days. Do you think that's an outlier, or maybe it's the valuation of the currency which brought up this situation in the bond market, or maybe you can ditch that indicator for a recession for good? Also,
what was the first part? What was the first part of your question?
Yeah, if the currently inverted yield curve is not reliable anymore as an indicator for recession, and maybe the cause that the fact is not working anymore is caused by the devaluation of the currency, too much printing and too much inflation. Maybe this indicator broke in some way. If you have an explanation why it's not working as an indicator of the recession, the yield curve inversion.
You mean the how they?
Yeah,
The bonds are
why
inverted.
the yield curve is inverted, right? It was historically has always been an indicator of recession, but it's not coming this time. So if you have any hint why it's not working anymore.
Yeah, I mean, honestly, the real reason is that what we're experiencing is what I was go back to what I was saying in the beginning at 100,000 foot view is that we're experiencing fiscal dominance, meaning that the U.S. government is spending so much money that it's completely dominating the economic landscape, and the Federal Reserve's policies are they're raising interest rates. It's not affecting the economy like it normally would. And then because we're running these deficits and all of those bonds are out there, and the Treasury has to pay interest on those bonds, they're pouring money into the economy through paying interest on those bonds to private investors, to individual investors. Because even though the Fed is the largest owner of those, it's still there's still $20 trillion worth of $20+ trillion worth of bonds out there that are being that interest is being paid on. And so that's really that's what's going on here, is that the money pouring into the system, it's still the M2 is expanding. And so it's not a normal environment. This is not an environment that we've been in, at least in my lifetime. It's atypical. But at the same time, what you're seeing and why we're hearing frustration is it's a little bit of stagflation, where the economy itself is not really growing, but inflation is still occurring. So you still have 3% plus inflation, and so that's what's frustrating people, and that's what's making it difficult for a lot of people in this economy. I just read that the middle class is which is defined in this article that I was reading, times the poverty rate. They're struggling. 2/3 of them are struggling and worried about payments on certain bills, and being able to make payments on their credit cards and on their auto bills. And that's a significant development in my mind. Is it across the board? No, it's not. And the lower demographic, the people who are making less money, are feeling it more, no doubt about it, because what we are seeing, what we're experiencing, is asset inflation. And so when the Fed talks about what their mandate is, what they're going to do, I mean, they've got two mandates, right? They've got price stability, which they talk about being a constant 2% inflation. That's just nonsense. We'll put that aside for a second. But the second thing they have is their second mandate is full employment. Okay, well, we haven't had a spike in unemployment yet. We are seeing signs of job weakness here and there, and we are getting conflicting reports. The JOLTS report came out and it's being revised lower. Like, these reports are being revised lower and lower. Anna Wong, the economist from Bloomberg, said that the jobs could be overstated by 1 million this year, just because of the way that the BLS reports them and calculates them, and doesn't include businesses that close properly. So that's again, garbage in, garbage out. It's difficult to understand what's going on in the economy with pure data. You've got to look at a whole host of points and kind of average them out to figure out what's happening. But going back to the Fed and their first mandate, which is 2% inflation. Well, first of all, when asked about that, why is it 2%? Powell just kind of fumbled around on 60 Minutes a few weeks ago, or I guess it's a couple months ago now, that he gave kind of a word salad answer. He didn't really have a good answer, except it came down to that's what they've always done. And the reality is, it's because it's what they can get away with. Okay, so going back to your statement is, well, why are we not seeing a recession? Well, you still have the money supply expanding, which is expansionary for the economy, and asset inflation causes inflation. So the Fed cannot lower rates at this point, because if we are truly entering a period of stagflation, that's kind of the worst scenario for them. right? Because if they lower rates and inflation spikes, it's on them. Nobody's going to blame anybody but the Fed for inflation spike. And then if they raise rates during stagflation, they could crush the economy, especially if spending kind of curbs out of Washington, or more and more and more money goes into spending on interest expense. Then that kind of that takes away capital, or just expands this deficit even more. So it's a really tough spot that they're in. Do I think that we're headed for recession? All things being equal, I'm seeing that there are conflicts in the economy, and on one hand, I believe that we're seeing, like we saw the ISM report this morning, right? And it was interesting because, and I want to see if I can pull it up here somewhere, but what was interesting about that report is that it was unexpected surprise to the upside. We just got a report out of Dallas on their manufacturing, their services, and their retail that was not so good. All right. So, but this report, on the other hand, it was kind of a surprise to the upside. However, when you go into the comments and you read about what people are saying, the actual people in this survey, they're talking about how the inflation is negatively affecting them. They're worried about a downturn. They're seeing signs of a downturn. So there's something that doesn't really add up there, and I'm not sure what it is. I have to dig deeper into those numbers to understand it better. But it was very interesting to see that report and what we're hearing, because again, there's conflict, and there's there's a lot of confusion out there about what's going on in the economy. Do I think we're headed headlong into a recession? The answer is no. I don't think we're headed headlong into a recession. I think that the government is going to continue to spend recklessly, especially in an election year, and do everything they can to avoid a recession. That's number one. On the other side, though, could we see a sharp downturn in the near term because of something unexpected? And that is an absolute yes. We could see something that happens, something in the economy occurs that, the saying is something breaks. Well, what would that be? Something breaks. You could have a large default on something that kind of catapult or it causes contagion, and it leads to multiple companies, large companies, being in financial trouble. And that could happen. Is it likely? Well, it's definitely way above a non-zero risk. How likely it is, it's impossible for me, at least, to handicap. But I would say that it is absolutely a concern of mine, and that's why I am not 100% invested in the market. That's why I do have an amount of capital that's sitting in treasury bills, not bonds, but very short-term bills that are not interest rate sensitive, to be ready just in case we do have that sharp downturn. But that's me. That's personally what my situation is.
Thanks a lot for the very interesting points. Especially, I think the one that you highlighted, they are very difficult spot at the moment, the Fed. Also, once Lynn Alder was asked, what would you do if you are the chair of the Fed? And she said, I would ask to change job, because it's a very difficult spot at the moment. Especially, it's even different compared to the 1970s, because increasing the interest rate is not as much deflationary as it was 50 years ago. Now that we have a big debt, as you highlighted, the interest on the debt is also increasing, and this is also inflationary. So increasing the interest is both deflationary, because people will get less loans, but it's also inflationary because the interest on the debt is increasing. As you said, everything is pointing on increasing money supply, keeping spending. Do you think then it's likely that they will agree on a different target of inflation, not because they want, but because they cannot keep inflation at 2%. I don't see they can keep at 2% in the next years.
Yeah, that's a good question. And my belief, and I've been saying this for a very long time, is that they will concede and lower rates before we hit 2%, unless we have something happens that's a sharp downturn that's completely deflationary because of some sort of black swan or an economic event like we saw last year with Silicon Valley Bank. Now, that said, the Fed is all over the commercial real estate situation and the treasury holdings of these commercial banks and regional banks. So I'm thinking that they're working hard to make sure that they avoid another scenario like that, and I'm hearing that they are. So, but to your point, I wouldn't want to be in Fed Powell's position. Like that sounds like an awful position to me, because like you said, if he lowers rates, we could see an inflation spike, and that's not good. If you raise them, you could force the economy into a recession, and that would be even worse. So we're kind of in a really gray area, and it's difficult to see where we're going to come out.
It's like we have the American economy is like under drugs, and or you give more drugs to avoid the recover, or you let him recover with a recession. But I think the more we keep printing money, the more that the reset will come at one point, the harder will be this reset.
Yeah.
They're kicking the can out down the road.
Yeah, and I just saw somebody comment that we've been talking about contagion for a long time. And look, I've been on Wall Street for over 30 years, and I've seen multiple 100-year events. I've seen the Russian ruble crisis with long-term capital management implosion, the 2001-2000 tech bubble, and then the 2008 financial crisis, and then the 2020 Great Recession, or I mean 2020 COVID recession. So, these things happen repeatedly. They're supposedly 100-year events, but they happen like every 5 to 10 years, and it's absolutely mind-boggling as an investor that you just keep having these kind of black swanish events. That you have hints of what's going on in the background. We If you were plugged into the market and to understanding what was going on in leverage back in 1998, and you saw what was happening with some of these spreads. So what happened there was long-term capital management was this hedge fund that had about $1 billion of capital, and at that time that was a lot of money. But they had about $100 billion of positions, and again, at that time, that was a massive amount of money. So if you were paying attention and you were clued in, you understood that there was somebody that was extremely levered in the market, then you were careful and you were able to keep yourself out of the line of fire. And what do I mean by that? Well, they had counterparty risk spread all the way across the street. And that contagion was so massive that it threatened to take down all the major New York banks. And I've talked about this before, but what ultimately happened is the chairman of Goldman Sachs walked into the Federal Reserve Bank of New York and begged to be bailed out because they were going under, because they had so much counterparty risk. And if they went under, it would have taken down dozens of banks with them. And so that's like an event that you just can't even dream of, that's happening in the background. Do I know that there's something like that happening right now? No, I don't. There are signs that people are all over with the commercial real estate exposure, with treasury exposure. And so if another regional bank has high treasury exposure, they have unmarked losses on that, they would have to sell and take massive losses on, and to get capital back to depositors. That would be a major problem. We just saw it with the bank and the Republican Bank in New York. So These things happen, and they're called black swans for a reason because you don't know when or how or what, and they happen more often than I would like to, endure, but they do. Am I a pessimist for that? No, I'm ultimately an optimist. I think that the treasury situation and the debt situation and our deficit situation, that only points to a period of high inflation for our economy. That's what it points to for me. I believe that that points to us having asset inflation because the Fed is and the Treasury are going to have to print more money in order to keep this going. They need the economy to expand, even if it's just in nominal terms. And so we must have that, and to keep this whole charade going, to keep the game going. And so I'm ultimately an optimist that we can benefit from that if you own the right assets. If you are positioned properly, you'll do just fine. But that's my message. As far as the black swan or an event that has contagion that's attached to it, we just don't know if that's going to happen. But what concerns me is that there is so much leverage in the system from the individual consumer up to the companies, up to the states, up to the sovereigns, that there is the possibility of something like that happening again. It's not a non-zero. It's a non-zero probability. It's higher than non-zero in my mind, and so I'm prepared for that.
Yeah, I think the same. They will have to print because they need to. It's the only way to keep the system running. And if we are the upcoming period is high inflation, it will be really devastating because 2 years of inflation 7% is not twice the impact of 1 year at 7%. It will be much more devastating, especially for the lower class or medium class who was already seeing the devaluation of the currency. And a further 7%, then a further 7% will be really a big event for them. I also was impressed by some ads were saying even the lower class is saying now that fast food they are not going to fast food anymore because it's too expensive. Also going to McDonald's is spiked from $12 to $19. They cannot afford anymore. It's really the sign that inflation is hitting even more the lower class. I will have also one question on the debt, especially because in your newsletter you explain difficult concept in easy steps. For example, as Bitcoiners, we know that we studied money and we know that it is a representation of goods and services. It's like a ledger of who owns what. So once the government is printing money, is giving a stimulus package, 1,400 to each person, it's clear that the amount of each person increased. So the representation of goods and services is represented by more unit of money, and the money, so the value is devaluated. What I think we struggle a bit is to understand how an increase of the interest of the debt has an impact on the supply of money, but which is the impact? Like what exactly happened when we say the interest of the debt moved from 600 billion to 1 trillion? Could you elaborate on this? I think many Bitcoiners will appreciate.
I mean, so what's happening is that we're just borrowing more money to pay that interest on that debt. So, and by operating in these deficits, we're pulling forward future. Basically, we're pulling forward future productivity into now. So debt can be, and it's not a bad thing. Debt can be a good thing. And if you are, say you want to open a business, right? You want to open a restaurant, and it's going to cost you $100,000 to open that restaurant, but you only have $10,000 right now, or $20,000, say. And so, but you could either work until you get that $100,000, which likely will be even more money by the time you work to get to that point. But let's just say you work to get to that point, which is in a few years, or you can, which means that you put off that restaurant for a few years, or you can borrow the money. You can use your 20,000, get $80,000 toward it, borrow the money, and open the restaurant right now. And when you do that, then you are pulling forward productivity into the now, and that's basically, you're getting that loan from the bank that creates that from it basically just creates that money in order to get it into the economy, right? So when you do that, though, you're now hiring people, you're buying products, you're buying your kitchen supplies, and you're generating productivity in the you're generating productivity in the economy. So by doing that, and if you do it responsibly, if you don't, expand to 3, 4, 5 restaurants too quickly and borrow too much money before you're making enough that you can cover all your expenses. If you're using that debt responsibly, that's okay. That's fine. That's adding productivity to the economy. But when you're my concern with the federal debt is that we're now in the position that we'll never really be able to pay this back. So if you look at not just the federal debt, the $36 trillion that we owe, but you also add to that all of the unfunded liabilities, which is Social Security, Medicare, Medicaid. That's future. Those are future liabilities. These are liabilities that they're going to be responsible for. And unfortunately, we're seeing a great number of the boomers, the baby boomers, now are getting to that age that they're retiring, and they're pulling forward the expenses at a rate that was a little bit unexpected. And so this means that our deficit goes even higher quicker because they're having to pay these boomers their Social Security, their Medicaid, Medicare, because they're retiring a little bit more quickly than they had before the pandemic. And so the issue here is that debt that they've taken on, the deficit that they're running, means that for people like me, like I said before, I'm Gen X. I'm not going to have Social Security that I paid in for. Like I paid into Social Security all my career, and I'm as of now, I'm only going to get about 70 cents on the dollar unless they do something drastic to restructure, which would mean that they're having the younger people pay in more than I did on a percentage basis in order to keep that going, or they just plain cut our what we're due in Social Security, or they just print money and keep running deficits in order to meet that margin. So that's irresponsible to me. And that's where we're at. And there's really no way out, according to the options that they have, like I laid out before. They're not going to take any of those options except print more money, issue more bonds, even if they have to buy them themselves in order to allow this to happen. The other thing they could do is they can allow for high perpetual structural inflation for a long period of time. And I'm not talking about 5 to 7% inflation. I'm talking about 12 to 15 or more percent inflation. It'll be a very painful period for certain people who don't have assets. But that's one of the options that they have. Will they do that? I don't know. Going back to your original question of will they raise that target rate from 2%? And I've been saying this before. I think that what's going to happen is they're going to declare victory before we hit 2%, and they're going to say, well, it's headed that way. And in their mind, they're going to say, well, it's kind of in the range that we're comfortable with, and that'll be the first step. And then it'll be the range of 2 to 3%, and then it might be the range of 2 to 4%. And then it gets people acclimated to it, used to it. Because think about it from first principles. There's no reason for inflation. There's absolutely no reason for inflation except to expand the money supply, to debase the dollar in order to endure this amount of debt that we have. And so we've been taught from very young age that inflation is normal. It's not normal. There's nothing normal about it. But what's the difference between 2% inflation and 4% inflation? It's just your belief that it's okay. That's it. And if they can get people to believe that, then they'll get away with it.
Yes, totally. But with the 2%, they can get away, I think, easier. With 4 and then 6%, they cannot get away because people will see that they're becoming poorer and poorer.
Sure. Where we're running right now, 3.3%, over the course of 10 years, you lose 30% of your purchasing power. That's painful for people. And so, and they recognize that you can't go into the grocery store today. And first of all, let's go back. First of all, if you believe that the real inflation rate is 3%, I mean, I don't even know what to tell you, because it's so manipulated. That number is so manipulated. I've written about it before. A lot of people have written about it. But when you go into the grocery store and you go buy whatever it is that you're buying, whether it's a car or it's insurance or it's your medical bills or it's medicine or it's your groceries, whatever you're buying, you can't tell me that it's only 3% higher than last year or 5 or 6% higher than 2 years ago. It's 10, 20, 30% higher. All of these products are. And so people are feeling it for sure. I 100% agree with you. However, if you have wages that are they will lag, but if they're kind of keeping up and you keep getting raises, then people will feel like they're keeping up. And so even if they're really not, because it'll get to that point where their purchasing power is decreasing, but it's normal to them. So if you're in a place like Venezuela or Argentina or Egypt or Lebanon, 2% inflation is a dream, but they have high structural inflation, and it's what it is. And it's been like that for a very long time in many of these countries.
Yes, and also the dollars has the advantage that is a global reserve currency, so it will be the last currency to inflate higher than before the others should have a high inflation, because every country who has high inflation maybe will use the dollar as a reserve currency, so we'll make this more deflationary for the dollar.
Yeah, no doubt about it. We do have that benefit, and the U.S. knows that, and they're playing off of that. But they also understand that, by keeping interest rates high, we're also causing problems for other countries, right? I mean, look at what's going on in Japan, for instance. So you've got Japan, who's been trying to ignite some inflation there because they've been holding interest rates down. They've been manipulating their 10-year treasury down for now years. And so, but what they've been trying to do is keep that interest rate low, manipulate it low. It's not natural. But by doing that, the spread between what you can get in the 10-year treasury in Japan versus what you get in the 10-year treasury in America is so great. That spread is so great that it winds up making people sell their Japanese treasuries or JGBs. Then they get their yen for that. They sell the yen and buy the dollar, and then they use that dollar to go buy U.S. treasuries. It's an interest rate arbitrage, and so that's what they're doing, and that in and of itself puts tremendous pressure on their currency. And so and we know that. So what happens there? There are knock-on effects from our policies, right? So we've got this situation where Japan they're spending mass amounts of money to shore up the yen and make sure that doesn't spiral out of control, which we've seen it rise precipitously over the last year. So what can they do? Well, Japan happens to be the largest owner of U.S. Treasuries. It owns over, and we're not talking about the Bank of Japan. We're talking about Japanese investors, but they own $1 trillion plus of U.S. Treasuries. So do we want them dumping U.S. Treasuries in order to get dollars, to sell dollars and buy yen? No, that's not what we want. So it's my belief that we will work in the background to open swap lines in order to loan them dollars to prevent that. Because imagine if the U.S. Treasuries out there trying to sell $2 or $3 trillion extra of Treasuries this year in order to meet the deficit and shore up the Treasury general account, right? At the same time that Japan is selling hundreds of billions of dollars worth of treasuries themselves. Like, they don't want that competition. It's the exact reason why the Fed, by Chairman Powell in the last meeting, emphasized that they're going to start backing off on their QT, which is selling the treasuries that we have on our balance and the Fed balance sheet. Why would they do that? Well, the answer is he knows that they can't be competing with the U.S. Treasury for demand in auctions and demand in the market. So when we've seen over the last 6 months a number of auctions that look really sloppy. We had a really sloppy 30-year auction back in November. We had a pretty sloppy 20-year auction in December. We had a sloppy 10-year auction earlier this year. And then we had last week that we had a few sloppy auctions of the 2-year, 5-year, and 7-year. It starts giving, look, it's not dysfunctional. The market's not dysfunctional yet. The U.S. Treasury auction didn't collapse or anything, but they're kind of warning signs that the demand wasn't there that they expected, and the auctions tailed, and the bid to cover, meaning the number of bids versus the number of bonds at the trail, wasn't very high. It was lower than historical. And so when you see that happen, that's when you realize that the treasuries got to work really carefully. And hey, look, I give Yellen a tremendous amount of credit to negotiating all this and getting through this so far, maintaining that balance, and still we still have 300 some odd billion dollars in the reverse repo facility. She's kind of teased that out carefully with the T-bill issuance, tilted all the way to the T-bill issuance. It's not the Treasury's fault that Congress is spending so recklessly. They're just trying to do whatever they can to maintain that balance and to facilitate it. That's their job. But their job between the Treasury and the Fed ultimately is to maintain liquidity for the U.S. government to borrow as much as it needs. That's ultimately what we're doing here. And so that's their job, and that's what they're going to do. So all of these knock-on effects and the consequence of our manipulation of our own rates and our policies and our debt and our deficits, it does affect the overall economy, and it comes back to bite us in certain places, and we're having to manage that. And that's what's happening.
According to Russell, the economist, talking specifically about Japan, he said that in his view, the Japanese government at one point is going to apply yield control through pension funds, both public and private, to make them buy long-term bonds. And that's a possibility. But I'm curious what you think about that. And also, if we circle back also to the current Western world of US condition, do you think also maybe the removal of the debt ceiling, which was actually suspended, I believe, but we know, and maybe it's sustaining the structure, the inflation, and can make it like to validate it as opposed to as a daily control, which can act as a savior in a 5 to 10 years scenario. Maybe they will try to take the value from where it is difficult to be seen, like the pensions. Is this a possibility?
What a possibility that they'll manipulate the rates for the pensions?
No, that they will apply this yield curve control by passing a law like Russell in Japan to force the private and public pension funds to acquire long-term bonds, government bonds.
Yeah. I mean, anything's on the table, right? I wouldn't put past them for any of that, because that's the whole point. That's on the table. I mean, everything's on the table in my mind. We're already seeing that the Treasury's out there, and this is not QE. I wouldn't call it QE, but the Treasury is out there buying long-term bonds that are off the run, right? So for people who don't know what that means, back in the day, when you were on a bond desk, you had these dot matrix printers, with the little the holes on the paper that go down the side and kind of rolls the paper out. We didn't have laser printers. We had dot matrix printers with actual ink. I see a few people in the audience who would remember this. But in the day, if you were a bond trader, you got this run. It was a stack of paper, and it basically told you what the bond prices should be for each bond throughout for that day. And we didn't have Bloomberg, there weren't updated pricing on bonds. It wasn't dynamic. And so if you had somebody call in, you would refer to that run, to that stack of papers to see what that price should be. And if it wasn't included on that run, because it couldn't have every bond on there, but if it was included, it means that it was very illiquid and it wasn't something that typically traded, and you had to take a shot in the dark as to what exactly the price should be. And so those are pretty illiquid and they don't trade very much. And so what's happening today is the Treasury's out there, and they have this operation where they're out there buying bonds that are off the run. Why are they doing that? Well, they're doing that to not inject liquidity into the market by adding more liquidity, but really just grease the liquidity and get these things trading a little bit more. So it allows for these banks and investors who have these bonds that are off the run, they're illiquid, to allow them to have something that's more liquid that they could easily move in and out of, and that kind of greases the gears of the Treasury market. But that's something that they're doing right there. Another thing we've seen is ISDA, the Derivatives Association, the International Derivatives Association, recommended that the Treasury and the Fed remove U.S. Treasuries from the leverage calculations for banks. Why would they do that? Well, it would allow the banks to own as many treasuries as they need to or want to, and the Treasury needs them to, and not have that count against their capital requirements. And so that is yet another thing that they're talking about. So these things are all signals that we have an issue here with just the sheer amount of leverage and debt that's in the system. Now, it doesn't mean I'm not saying, and I don't believe that this whole thing collapses in the next year or two. That's just not, I don't believe that. I know some people do. That's not me. I think this can go on for a very long time. And the reason it can go on for a very long time is what you pointed to before, is that the US dollar is the reserve currency, which makes the US Treasury the reserve asset of the world. So that gives us tremendous amount of runway to continue to operate like this. And if you just continue to add money to the system and people continue to have confidence in the US dollar as the go-to currency, this can go on for a very long time. And will it hurt other currencies? It will. And we're seeing indications of that. But the US dollar will be one of the last, if not the last one standing. Maybe it'll be the Swiss franc. I don't know, but it will swallow other currencies along the way. That's my opinion.
Yes, I agree. it will be or the last one or the one before the last one. Thanks again, James, for all this summary on the macroeconomic situation and where we are heading. I think it's also interesting. We have a podcast called Bitcoin as a store of value, and the first hour we barely discuss about Bitcoin. That's the great things about Bitcoin. It's so multidisciplinary that it involves so many different aspects. Maybe it's time also to move towards Bitcoin and elaborate on why you think that people owning hard asset like Bitcoin will be off in a good way in the next years.
Yeah, I mean, look, I have been studying Bitcoin not as long as many people here. I'm an institutional investor. I feel like I came to the space late. I ignored Bitcoin like stupidly, like many people in my space did and still do. I just wrote it off as a speculative asset and didn't really pay attention to it. So I'm evidence that the more you study about it and the more you learn about it, the more you understand how Bitcoin is different, how it is truly decentralized, how it, the fact that it's immutable, it's anti-inflationary, really. It does have a small amount of inflation embedded in it, but that ends and is really minimal going forward. And so as the U.S. money supply or the global money supply expands, because this is not a U.S. asset, this is a global asset. As it expands, it has protective features against that. You're not going to get more than 21 million Bitcoin ever in the world. So we look at it here, U.S. centric, as an investment typically. But around the world, you're seeing people adopt Bitcoin as a store of value already because they have currencies that are deflating, that are devaluing so rapidly, right? So you've got places like I was listing before. You've got Lebanon and you've got African countries, a number of them. You've got Venezuela, Argentina. These places have citizens that are experiencing super high inflation. And so rather than leave their money in their local currency, and it's very difficult to get dollars out there in certain places, not all places, but in some places it's difficult to get dollars. And so what's the best thing to do? Well, if they have a cell phone, they can likely get to an exchange to buy Bitcoin. And then it doesn't matter if Bitcoin is volatile, because to them they would rather stomach the volatility in an asset that's ultimately rising versus having volatility in an asset that's rapidly devaluing, which is their own currency. But that's happening across the world. Is it happening rapidly? I think it's from the charts and images we've seen charting against adoption of technologies. It's kind of happening typically. You can see it in the log charts of technology adoptions of things like the internet and cell phones. But why would I believe in Bitcoin long term? Well, I do believe in it long term for those reasons I stated. It's like not even a gold upgrade. It's like a gold. It's like gold on nitroglycerin. I mean, it's like this asset has features that gold just simply could not have. You can't transport gold. It's difficult to verify gold. At least compared to verifying Bitcoin and the exchange and the addresses of the coins. So why would I think today is a good time? Yeah, it's up quite a bit. It has soared this year from the 40,000 all the way up to 70,000. But why do I think it's good? We've had some events this year that warrant this rise in valuation, and the events of the ETFs are massive. The fact that institutions can now buy Bitcoin the same way they could just they can a regular stock, it's a monumental shift in that space. I know it because I lived it. It's just the bar to buy Bitcoin in a regular institution before the ETFs was so high that it blocked out virtually 98% of them, 99% of them. It's just the career risk, the individual risk, the personal risk of owning Bitcoin and having keys, and the settlement, trading on exchanges that didn't have SEC oversight. It didn't make any sense. It was very difficult for them. So that was a time before January that for the first time, retail investors kind of front run the institutions for the first time. And so they got the ability to buy into something that the institutions now suddenly have access to. And the funny thing is I thought that there would be widespread adoption pretty quickly. And it's probably because I've been doing so much work on Bitcoin myself. I figured they would get up to speed quickly, but they're not. We're just now seeing a few institutions here and there get up to speed and add Bitcoin in very small amounts to select portfolios. Will grow, and I was talking about this last night. And that will grow, that tiny little position, as they keep doing their homework and understand why Bitcoin is different and how it can augment their portfolios, how it can actually augment their risk adjusted return. That makes it compelling. It's a compelling asset to have in portfolios, in virtually any portfolio that could own a mix of more than just a certain type of stock. And if you have a portfolio that is somewhat diversified, this would likely add to the risk adjusted return according to the last 10 years. So I believe that institutions are going to they're going to continue to do work on this as it becomes more and more adopted. We're seeing ETFs and spot ETFs be approved around the world now. It becomes the asset that suddenly, if you don't own it, you're on the wrong side of the coin.
Totally agree on the institutional adoption and also the monumental change on the ETFs. Thanks to explaining, especially coming from someone who lives really in the financial world. It's very important to have education from people who are coming from this world, especially at this moment where the institutional adoption is so important. And do you think, how long would it take for this institution? Because as you said before, the ETF, it was not even on the table to own Bitcoin. Now the product is super regulated. We will see the real capital from institution in the next 3, 6, 9 months, or it will take years?
I think that over the next 3 to 6 months, you're going to see some big names enter the space. All things held equal, the economy doesn't collapse on us, and we're kind of still grinding sideways here. I believe that you're going to see some institutions that are big names that come into the space and announce they own some, and that's going to set off a little bit of a flurry. I think that'll be a big event, depending on the names of the institutions that do come in. But I do think it's going to be more like right now we're seeing just barely a trickle, and that'll turn into a little bit of a flow and a stream, and then eventually it'll turn into a river. I don't think that river occurs this year, personally. I think it's going to take 12, 18 months for these institutions to really get comfort in this space and with this asset, and see that there's no problems with it, see that the settlements work, see that the ETF managers are keeping the underlying Bitcoin to the NAV, and it's not trading at premiums, it's not trading at high cost to the individual investor, seeing that there's no problem with the custody of the asset. Once they get through that, like they first have this first period of 60 to 90 days just to see operationally it works. Okay. And that people are buying it, Yes, it has really taken off from 40,000 to 70,000. This is not going away. We'll dip a toe into it. But then as they start doing their work, this is going to be, in my opinion, it's going to be a longer drawn out process. And you know what it's like. We see FOMO in the retail world all the time with stuff like the meme stocks and tech stocks, and you see FOMO all the time. But there's still FOMO in institutional investing too. These guys are standing around and saying, "Wait, you own the okay? So you own Bitcoin, and you own Bitcoin? Oh God, I better own some Bitcoin." If you go back to 1998, 1999, when Amazon came out, people were laughing. Institutional investors were literally laughing on silent on the calls with Jeff Bezos when he was declaring that he was going to expand away from books. He was going to do electronics. He was going to be the biggest retailer in the world. They were literally laughing at him, and they were shorting his stock. They didn't believe. They just refused to believe that anybody would put a credit card online and buy something that would be delivered to them. They just couldn't comprehend it. Well, now if you don't own Amazon and you're some sort of technology or consumer fund and you don't own it, you have some risks there, so that it's flipped completely. And I believe that eventually happens. Now, how long that took, it was a number of years. It took a number of years for Amazon to flip that script. And part of that was they finally disclosed how much money they were making in their web services, and that's really what set off that flurry of buying in Amazon, and it took off from there. But it's a process, and it takes a while, and I don't think it's going to happen today or tomorrow. But I do think one thing that people discount is the fact that when you're an institution and you've got 10 million, 20 million, 50 million, $100 million of something to buy, you don't go out there and say, okay, buy $1 million at $71,050, buy $1 million at $71,050, at $71,100. You're not giving price points to your traders. You're basically just saying, okay, I need to buy $10 million worth. I need to buy $50 million worth. I need to buy $100 million worth. Do it over the next 3, 6, 10 days, whatever, and just participate with the market. Try not to move it yourself and just go along. Just try to stay with the pricing of the market. And when you've got, dozens or hundreds of small buyers or small institutions, a dozen big institutions doing that all at the same time, that's when you get price increases that you see that kind of surprise people, because there's pockets of illiquidity that they have to kind of jump through in order to get the liquidity that they want or need. And so the price can move before you have a huge amount of institutional inflow, right? So that's something that we've heard the price multiplier, and it's difficult to determine exactly what that would be in Bitcoin. I've seen a lot of models on it. It remains to be seen. But one thing I can tell you is that as institutional money comes into the space, as Bitcoin's market value gets up into the multi-trillion dollars, the volatility of this asset will decline. And one of the main reasons for that is that when you have a number of institutions that own this, they have to maintain a certain balance in their books. And they've got a 3% position in it. Well, if Bitcoin doubles, they've got to scale back. So that's going to temper the rise in Bitcoin from just doubling, tripling, quadrupling. They're going to scale back. They're going to sell some because they've got to maintain that allocation, their percentage allocation in their book. And the same thing goes for when it drops. If Bitcoin drops 20, 30, 40%, and their 3% positions now 2.5% position, well, they'll top it up. They'll go, okay, buy some more, top it back up. And so they maintain that exposure. And so that will dampen the volatility. both because there's just going to be that much more liquidity and because of that dynamic of reweighting in their portfolios.
Yeah, I mean, regarding the adoption of Bitcoin, its price impact, particular fact is that it's the monetary technology. It combines two features of with two way of growth and based on the network effect and market capitalization, because it's also a currency. So that piles up one to the other and drives this aggressive price rise as we have seen. Also, if we compare the last price movement from 2020, ranges from 2019 to 2021, last cycle. Now we have, back then we had seen some retail purchases in the beginning in 2019, 2020, and then after that we had MicroStrategy who announced the interest to MicroStrategy, and then the cycle somewhat somehow ended. But if we compare this to now we have seen the retail ETF purchases is driven by retail at this stage, because the 90 days windows hadn't passed yet. But now maybe behind the scenes there are some movement, as you also hinted. And then I think all of the cycles are mixed cycles. They are not pure retail, not pure businesses, but some in a way mixed. And this could be no different. And there are all of the signs out there to make it happen in this way, because the ETF will boost this behavior more and more. Yeah.
Yeah, I mean, the last cycle you could argue got cut short because of all the fraud and nonsense with FTX and all. So and this look, it's a very small set of data. We're talking about just a few cycles that we're talking about, right? So there's not enough data to really rely on. To say, well, this is what's going to happen because of the last cycles. This cycle could be more powerful than last cycle because it got cut short because of the fraud and that sharp sell off of the digital asset space, and additionally, it could be much more powerful because we do have that ability for institutions to actually buy Bitcoin through these exchanges, which require the exchanges and the managers of these ETFs to buy the underlying Bitcoin. That could be a very strong catalyst for Bitcoin in this cycle in particular. Another thing is, like you said, when you start having companies that announce that they're putting this in their treasury, well, that is going to further legitimize Bitcoin as a separate asset class, and it could spur more and more adoption of it. And I hesitate to say FOMO, but that compelling argument that, well, maybe we should own some too, right? So if you look back in the 90s, when you look at the Yale endowment in particular, and when they started buying these, David Swenson was the fund manager for the endowment, the investment officer, and when he started buying alternative assets like hedge funds and private equity, the other endowments thought he was just nuts. They couldn't believe that he was going out on that risk curve. But when his returns started outshining them markedly, then a number of other endowments jumped on board and said, maybe we ought to be adding some of these alternative assets to our portfolio as well. And so he was kind of he led that. He was one of the ones who really led that charge. So that's, but I can see that happening with Bitcoin as well, to see some endowments adding it, and then suddenly you've got more than one, and then you've got dozens, and then you've got hundreds of them, and that's just the natural way. People, they sometimes wait for an investment to be de-risked before they are willing to go into it.
It's like no one want to be in the first row, but no one want to be also in the last row. So at one point
Right.
they will be this, let's say, gradually and then suddenly phases. On the topics you
Right.
said, to be late and to have the first misconception, dismiss Bitcoin. I think every Bitcoiners, me as well, but I hear many, they are saying the first time they dismiss, or you think it's just a speculative asset, so it's normal. And it's even normal to be late, to feel to be late, while in reality, we are very, very early. I believe we are not more than 100,000 people overall the world who have such a deep understanding of Bitcoin. And even Max Kaiser say he bought Bitcoin when Bitcoin was at $1. He was also thinking to be late because there was someone else who bought at 30 cents. So now also people think that 70K is also late, but in reality, it's not that late, not that late. On the inflection point, do you think also there is a price or a level where after this, then also for the people adversarial to Bitcoin will be hard to still be against Bitcoin, and when also the people who are neutral, financial advisor will start to say, okay, I need to have also one Bitcoin or a portion of Bitcoin. My personal opinion is maybe 160, 180K. And the reason is at that level, it will be the second biggest asset by market capitalization of the world. I really struggle to see a strong position against Bitcoin at that level. What do you think?
Yeah, and it's a good question, and I think, well, it may not even have to get there, to be honest. I think there's a lot of institutions that are sitting around watching this asset bump around near its all-time highs and wondering, is that it? Is that the all-time high? Are we going to back off of that, or should I be waiting until it comes back to 30 or 40,000 to 25,000 to be buying it again? Is it just this super volatile asset that you trade around? How is this thing going to work? So I do believe that when we crest this all-time high again and hold that $70,000 level, that $75,000 level, call it, and there will be a gravitational force to 100,000, and it'll gravitate to there. I don't think it holds there. I think it backs back off. I think there's going to be a lot of emotion around that $100,000 level. That's what I would expect anyways. And it's just that number that's $100,000 per Bitcoin. I do think that though, once we break through that 75,000, that it gravitates toward there. So what that means for institutions though, is that they that will be the first kind of wake up call. Okay, now it is above 75, it is holding there and is gravitating towards 100. And that'll be kind of a level where I believe that if you've been on the sidelines, you've been waiting to see if it's going to break through and hold here, that's probably a pretty good sign. And then once it does break through that $100,000 level and it kind of holds above that $120,000 level, that's another just mental level for people that they'll think, okay, this is for real. This is an asset that's now approaching $3 trillion, and this is something that cannot be ignored anymore. But remember, we're talking about an asset that if you look at Bitcoin as a separate asset, like gold, I mean, gold is somewhere between 1% and 2% of the total assets, investable assets in the world. If you count real estate as a 300 trillion and all investable assets total at 900 trillion, Bitcoin it's a fraction of a percent of that right now. So once it gets to be a full percent of that, that to me is when it has really come into its own as a total store of value. So that's going to be a tremendously significant event in my opinion.
Yeah, I believe the same. Once it will be reaching this level, then it will be globally recognized as a global store of value. At one point, no, I don't want to FOMO so much.
And also because at that point volatility will dampen quite a bit. So
sure.
yeah.
Also because many institutions like pension funds or insurance funds, it's not that they are selling after 6 months. They take time to decide of the asset, but then once they put 1%, it's not that after 2 months they sell because Bitcoin went down 10%.
That's
They
right.
are not retailers. At one point, when you said it's true that people, let's say, institution will put 1% and after 6 months will rebalance. So this will generate maybe a decrease of price, but I think this decrease will be overcompensated by the overall agreement on a Bitcoin allocation increasing over time. So now we are discussing maybe about 1%. Then soon they will discuss about 3%, then 5%, maybe then 10%. So it could be that it really goes up with, for sure, some retracement, but without a real bear market, as we have seen in the past. It could be an option.
I mean, remember to have 10% of gold in a portfolio is pretty significant. So 10% of Bitcoin in a portfolio for an institutional investor, I think that's outside the realm for a while, to just be honest. But the rebalancing, I mean, that typically happens quarterly-ish with your typical portfolio. But I agree with you that that's how it stair steps. They get 0.5%. Like right now, we're just seeing 0.1% in some of these pension funds, but eventually they get 0.5%, then 1%, then 3%, and then maybe up to 5% in certain portfolios that they deem it's the right balance for that risk reward. So, but along the way there will be rebalancing, which means that it will dampen volatility. I don't think that it dampens the price increase overall, like over a long period of time. I just think that it helps to balance out that volatility, which will only attract more investors that are in institutions as they see that it's not whipping around at 5, 10, 20% a day anymore. So that's going to be a significant development.
Yeah, interesting. It will be. Yes, Francesco.
Okay, it's important to observe the volatility, the possibility this asset to be more and more decorrelated from the stock market, because the real test is in the bear market, and that's where you find the true value. If we have this hint at the beginning of the ETF cycle, where given the massive retail demand, it decorrelated for a couple of months from the Nasdaq, for instance. So if that happens because of the company's businesses adoption of the larger purchases, it will decorrelate even more, and then I think that's an indicator of Bitcoin success. It should be as a good store of value, decorrelated over time.
Well, correlation. So let's talk through that for a second. When we have a market event, we have a saying that all assets correlate to one, which means that everything sells off. Why does that happen? Well, it happens because when you're a portfolio manager and you're seeing a sharp sell-off in the market, you know two things. Number one, you know that you're operating on margin, and if you're just on Reg T, you're probably fine in most of your positions, which is just borrowing half of your capital. But most of these hedge funds and are operating, especially hedge funds and investment funds, are operating on something that's different from Reg T. That they have portfolio margining, which is a lot smaller haircut, which means a lot larger borrowing loan to value. So when you walk into your desk in that morning that things are selling off, with your first reaction is just sell 10% of everything. And when you have a market shock that's happening, you're like, sell 10% of everything because I don't know. I know two things. The market's going down and I don't have time to figure out what to sell and what not to sell. Number one. Number two, I know I'm going to need capital. So everything correlates to one. And so that just is reality. It's what happens often in the market. You'll see bond sell off, stock sell off, gold sell off, oil sell off, like everything. It's like, holy, like you can't hide anywhere. And so I would not be shocked if we have a market event and Bitcoin goes with it. Now, that being said, if you have an event like we saw last year, back in March, April of 2023, when you saw the collapse of Silicon Valley Bank, and suddenly you're seeing Bitcoin go up in the face of that. Well, that's interesting because now you're talking about fleeing your typical store value of dollars and getting into something that you can protect yourself in. But that was, I mean, the whole market didn't just collapse, first of all, but Bitcoin did run. It ran from like 20,000, if I remember, up to like 28,000 at that time when this was happening, and then even up into the 30s. So you can have events that are specifically uncorrelated and positive for Bitcoin. I'm not going to try to predict that because Bitcoin's pretty much impossible to predict. But that was interesting to me, and that was a pretty strong indication that it will eventually become uncorrelated to certain types of events, and that's so that was interesting.
We may be entering a phase where everything is good for Bitcoin. If we go inflationary, it's good for Bitcoin. If we have a recession, it's also good for Bitcoin. Yes.
Yeah. Well, yeah, but what we don't want to have, and I hear people say this all the time: just burn it all down. That the whole thing collapse and everything get revalued in Bitcoin. I think that would be catastrophic. It would be a super negative event for the entire world. There would be a lot of pain and suffering, and I would rather see Bitcoin operate as in parallel, and the adoption continue in a steady pace over a long period of time. I think it just makes everything stronger.
Totally agree. And also what people are missing to understand is Bitcoin can go to 70K to 2 million without causing any big issue without having a big issue in the society. It's just
Sure.
the institutional world moving because they are looking at the price. They are saying, oh, 70,000. Oh, it looks too expensive, but expensive compared to what? As you said, you should look at the market cap. It's 1.5 trillion. Real estate is 300 trillion. Stock market is 550 or 70 trillion. Bond is 300 trillion. These are the numbers we should look at.
Yeah, exactly.
We are approaching, I think, the end of the space. James, I would like to say thanks again for all your great insights. It has been a great pleasure to have you on stage. Firstly, do you plan to be in Europe anytime soon? I was not in Madeira, but I saw your panel and it was great.
Thank you. I did make it out to Madeira. That was awesome. I am not planning on being in Europe this summer at this point. I may join the Prague conference next year, but
Okay.
I don't have plans to do it this year. But I'm seeing if it would be at all possible to go out to Amsterdam. I'm working on that, and I'm probably going to go out to Peter McCormick's event out in Australia in the fall. So
okay.
I've committed to that. So that's my plan right now. But I will be in Nashville for anybody who's gonna be out there. Definitely look me up and say hello. And I'm looking forward to that one. So, but I probably should travel a little bit less right now.
Okay, maybe then see you in Prague or Amsterdam if you join.
Absolutely.
Will be great.
Absolutely.
As always, we ask any closing remarks you have for the listeners on Bitcoin.
No, I mean, I just want to emphasize. Well, first of all, thank you, Alessandro, for having me. I really appreciate it. And you have a great space here, and I see a lot of friends in the audience, and I appreciate all of you coming out to listen to me drone on. But what I do want to emphasize is that I'm ultimately an optimist, and these things that I point out is to help people position themselves to be sure that they protect themselves from what I think could be a long period of pretty high inflation. So I hope that everybody gets the Bitcoin they need and their investments in order. And but it's super personal, and people need to they need to do their own analysis of what their exposures are. That's just the way it is. But I'm personally super positive on the space. I'm super positive on Bitcoin long term. I've dedicated my work life to analyzing macro events and investing in the Bitcoin space. So that's me. But I appreciate you guys sincerely for having me, and this has been great.
Thanks a lot, James. Francesco, what will you
Yeah,
say?
James, me also, like Alessandro, I've seen, watched all of your videos and your teachings are awesome having talked to you, because given your experience, we found out tonight that there are many inefficiencies in the fiat system. In fact, we spent a long time talking about that and many question marks, but then in the end, talking about purely about Bitcoin, we had many more answers and many more certainties than the unfortunate system we discussed before. So thank you a lot for having been with us tonight, and I hope we're going to see you one of the conference going forward. Thank you very much.
Absolutely. Thank you, Francesco. I appreciate it.
Thanks, Francesco. I can only double down on the pleasure to have you here on stage. I think many great insight for the listeners is what we are trying to do. We are focusing on Bitcoin as a store of value, so we are trying to provide great content from very knowledgeable people on Bitcoin. I agree with you, James, saying Bitcoin at the end is up on the people on studying Bitcoin. What we can do is to provide the content, make people thinking about Bitcoin, but then it's on them on study, on really do the work, the proof of work, studying Bitcoin. And last but not least, I am really positive, especially in the next 12, 18 months. I wanted to say before, for Bitcoiners, 12, 18 months is kind of short term. We have lower time preference. We learn time preference, so we can wait the institution. And for me, Bitcoin as a store of value, at least, already won. We are just waiting the world to realize that Bitcoin is the best store of value that the humanity has ever had. So it will be a great journey. Thanks a lot, all, and see you in the next one of the next spaces. Bye, all. Bye again, James.
Thank you. Bye, guys.
Thanks. Bye.